FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 8/13/19. Well, been watching gold go up, up, and away. Well, today it got slammed, but the day is not over yet. So we'll see more about that later. Hey, but what is behind the latest rise in gold? What's with recession fears? Is the world heading into a global economic meltdown? Well, our good friend Jim Welsh is with us now. You find your work, Jim, at macrotides.com. And hey, welcome back. So we heading for a global recession?
No, I don't think so, Kerry. And thanks again for having me. I really appreciate our opportunity to have a conversation about all this good stuff. No, I think things are going to continue to slow. What we have seen over the last 6 to 12 months is a fair amount of weakness in the manufacturing sectors, not just in the U.S., but globally. And that's in due part because of the tariffs and the impact on countries that have more exposure to manufacturing. In the U.S., manufacturing is 11% of GDP, Germany's 22%, China's 30%. So the more exposure any individual economy has had to manufacturing, that has been hit harder by the tariffs and the resulting slowdown in that area. Conversely, looking at the service sectors, not only just in the U.S., but also in Europe and in China, there's a huge and has been a very wide spread between the weakness in manufacturing and the really relative stability in the service sector. And I believe, and as I wrote in the most recent issue of Macro Tides, is I think we're going to see weakness start to spread and infect the service sector. And we got the first data point kind of supporting that last week with the ISM non-manufacturing number for the U.S. dropping from 55.5 down to 53.7. It's still above 50, but it's weakening. And the same thing I think is likely to happen around the rest of the world. So my guess is we're going to see the weakness in manufacturing continue. I think the ISM manufacturing in the U.S. will likely drop below 50 in the next handful of months, and we're going to see the service sector stuff also weaken. And lastly, I'll just quickly add the employment report. As you know, a lot of people looked at 164,000 jobs. That was expected. Unemployment rate still near a 50-year low. Average hourly wages actually ticked up from 3.1 to 3.2. And as I've noted in a number of videos and some of my writing, those are all great numbers. But if you look under the surface, you're starting to see some, signs that things are weakening in the labor market. Number of overtime hours has dropped significantly. Total hours has also dropped from like 1.5% to 2% annual growth rate to like 0.75. And if we think, Kerry, about, if you're running a business, what do? When things start to slow down, you got people that are working overtime, well, you cut back overtime hours. Then you reduce somebody who's working 36 hours, you cut them to 35 hours. So the next shoe to drop, I think, and it will show up, is slower job growth. Already the 6-month average of job growth is the lowest in about 5 years. And a lot of people focus on unemployment claims. But that's further down, if you will, this labor market chain. So I think the next thing that we'll start to see is more slowing in the job market. And ultimately, we might see a small tick up in the unemployment claims and unemployment rate. But bottom line is, I don't believe we're headed toward, certainly not a global recession. Global GDP still probably hovering around 3%. U.S., I think GDP could slow to less than 2% over the next handful of months. And the main thing is, I think we're going to see economists revise their GDP estimates and earnings estimates lower. And I think that's one of the headwinds that the U.S. stock market is going to face in the next few months.
Mm-hmm. So you think that they're going to tick up because, the new claims for unemployment insurance really are generational, multi-generational lows.
Yes.
And they've kind of defied gravity and expectations for months now.
Yes.
So, but you don't see this becoming a conflagration?
FSN Radio. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex trend and is advancing the Copper King project towards production in Wyoming, led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well-capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Not yet. Again, I think what we're seeing is a natural slowing, and it's showing up, as I said, in a reduction in overtime hours, total hours worked. So even though wage growth picked up from 3.1 to 3.2, if you're now working one fewer hour because your employer has cut back a little bit, you're what's happening to your paycheck? It's maybe not growing as fast as it was 6 to 12 months ago, and so. Ultimately, as this plays out, it's kind of like in slow motion because there's nothing that's really driving this. And if we think back to most economic slowdowns, meaningful slowdowns, recessions, and so forth, it's usually the result of monetary policy where the Fed has raised the cost of money to such a level that people can't afford to buy a car, can't afford to buy a house. That certainly is not the case. And the other instances where the Fed is tightening liquidity to such an extent where the availability of credit begins to shrink, and people who want and maybe could qualify for a loan, but lending institutions won't lend them money. That isn't the case either. So the drop in rates that we've seen obviously is helping refinancing activity, should help housing hold up okay. I think we're just seeing a slow motion process of things gradually slowing. And if the tariffs, in fact, do go into effect in September, and as you know, this morning, President Trump announced that some of the tariffs slated for September 1 are going to be moved back to December, primarily on consumer goods. They haven't provided a list of which ones are going to be postponed or not. But again, all this does is make things slow down, but I don't think we're on the precipice. And the central banks in Europe, especially, pushing the policy rate down to minus 40 basis points with the ECB did a couple of years ago. They're hollowing out their banking system. And so I think that's a problem. And, that's going to impede growth in Europe. Germany is 30% of Europe's GDP, and it is being hit harder than anyone else in Europe. So, we are going to see the global economy slow further. But I just don't see, unless there's some kind of trigger, in the past, big spikes in oil prices, which affects the global economy, in mass, if you will. I just think we're going to continue to see what we have been seeing, an ongoing slowdown until this trade stuff gets resolved.
Okay, well, it's a reasonable forecast. Now, what about precious metals prices? They've been on the upswing for past 2 months. We're going to see more of this, and what's leading to it? What is causing the upsurge in metals prices? Well,
I think there's a lot of factors. I think Gary causing it. The drop in global bond rates, I think, has unnerved a lot of people. When you think about it, in Europe now, someone can borrow money and get paid by the lender for getting loaned money. That's turning, if you will, the credit creation process upside down on its head. And I think that has unnerved people, and the slowdown in the global economy, and then just simply price action. There's a lot of money that looks what's moving, and whatever is moving, especially in an environment when you think about it, the S&P in the last 18 months is virtually unchanged. So even though we've had these big wild swings up and down, for someone that's not trading, you haven't really gotten paid for much for holding it. So I think there's a number of factors. Chart-wise, technically gold breaking out above 1375 also brought in a wave of buying. So I think there's been a number of reasons why gold has had this big move. But the two things that I would kind of sense caution, and when we last spoke, it was like we were both looking for a pullback and then another leg higher. And right. So the market, gold has kind of followed exactly what our conversation was. I think it's time to probably become a little bit more cautious that a deeper pullback, I think, is coming. And two things. First of all, last November, when gold was under 1,200, the percentage of bulls was under 10%. Now we're in the mid-90s. So a lot of people have bought into, oh, look at the big move in gold, got to get in. CNBC, almost everybody's talking about, got to have some GLD,
Yeah.
And then the positioning. As of a week ago Tuesday, the large speculators had the second largest long position in the last 15, 20 years. The only time it was a little bit bigger, and we're talking about 24,000 contracts bigger, so not a huge difference, was in July of 2016, after that huge move up from 1050 to 1375. And gold then went through, a consolidation and a pullback. So based on sentiment, positioning, and we're starting to see some momentum divergences. Gold is pressing higher, but things like RSI are not confirming it. So to me, those are all warning signs that I think gold is near a pullback. And I think there's the potential that gold could drop back towards 1,400, maybe even 1,380. Just take it as it comes. But I think this is not the time to be chasing gold. I think one would be better served to wait for at least a pullback to 1,425. After that, I think gold prices are going to go higher, over the next 6 months or so. So from a tactical standpoint, I think it's time to lighten up a little bit and look to, go back in after we get a pullback and sentiment starts to cool off. And the dollar could play into that a little bit. I know everyone's expecting the Fed to cut rates and the dollar should go down, but I think there's an issue with dollar liquidity throughout the world, and the trade-weighted dollar index last week made an all-time high. And most of us focus on the straight dollar index, which is what gets quoted on CNBC. There's futures traded on it. That peaked at 103.80 in January of 2017. Most recently, it's been trading around 97. So it's about 6% below its all-time high, but the trade-weighted dollar is at an all-time high. And the reason why that's important is I think it's putting pressure on dollar-denominated loans in the emerging market, including China. And China's support the yuan, I think, President Trump is not acknowledging that for quite a long time, China has been trying to support the yuan and not allow it to depreciate. But in order to do that, they need to sell dollars to buy the yuan and also knock the dollar down. And I think there's the potential that you could see a spike in the dollar if things kind of come to a head, especially maybe triggered by events in Hong Kong. So I'm not sure what exactly is going to cause the pullback in gold, Kerry, other than looking at sentiment, positioning by large specs. The commercials are on the other side of that big short. And maybe also, just as importantly, momentum indicators are starting to show that as powerful as the move up has been, it looks like it's starting to run out of steam. So, I think it's a good time to lighten up on the precious metals at this point.
Yeah, well, I talked with Charles Nenner, noted cycle forecaster. He'd been calling for gold to go up back in June. He was saying it's a buy, went up 150. Since then, he said it was making a short-term high either yesterday or today, going to pull back a bit. But he's thinking that that gold could hit 2,500. So,
again, metals can move like no other asset class. And they do have a tendency to spike near the end of moves, where they look the shiniest, if you will. My take on the U.S. stock market is that I think at a minimum, I think the S&P is going to drop to 2730. That was the low on June 3rd, March 7th. But if the S&P takes out 2650, Terry, I think there's the potential that the S&P could drop all the way back down to the December lows. And that's based on a huge megaphone pattern that's been developing in the S&P since the January of 2018 high. So you had an A wave down to 2532 in January, February of 18, rallied to new all-time highs last September, then a break to the lows last December, a rally back up to a modest new high over the last few weeks for wave D of this triangle and megaphone. And what it implies is the potential of a move all the way down to 2350. If something like that develops, what we've seen is weakness in the equity market has driven some money toward gold. So if he's looking for a move that potentially that high, I mean, it sounds crazy, but if events unfold that cause the S&P to drop down to the December low and gold is still performing well, you'll see money rotate toward gold. Again, just very short term, I think it's time to lighten up and look for a pullback to buy over the next few weeks, maybe by Labor Day, and then look for another move up, and we'll see how crazy the world becomes. I still don't believe there's going to be a deal between the U.S. and China. There's a lot of reasons, long-term reasons. China strategically does not want to give in on some points. People expect President Trump to behave like a normal politician and cave in. And you would think by now most people would learn that Trump is unlike any other politician. And I really believe, and on this point, I truly agree with him. Whoever wins the technology dominance in the next 5 years will then really control the next 20 to 30 years. And I think that's really what this is all about, is technology. And that obviously relates to intellectual property rights and so forth. And, China has a 100-year plan. There's a great book called The 100-Year Marathon by Michael Pillsbury. I would urge anyone who really wants to learn about this stuff, read that book, because there was a guy who has really done a 180 in terms of his view on China. And, he provides some great information that's worth reading. But the bottom line is, I think China has their goal that by 2049, they will be the dominant global power. And I think President Trump and his advisors see that, and I think they're serious about, holding the line. So I think there's more pain to come out of the train stuff, irrespective of today's announcement of a modest pullback in some of the tariffs until December.
Yeah, well, it's all posturing, all of that. Let's face it. But hey, push comes to shove. Decoupling of the U.S. economy from China looks like it's on the table. And, I'm not going to pick sides on it other than to say, hey, the U.S. is a currency manipulator, just like China is, always has been. And really, what's new about all this? Countries always do this. So,
but I mean, to that point, or adding to that, I find it very interesting. The central banks have adopted a arbitrary 2% inflation target. And there may be many reasons why we're not getting to 2%. But if one sits back and thinks about it, money doubles in 36 years at 2%, and quadruples in 72 years. So, the average lifespan in this country is close to 80 years. And I just find it almost humorous that, somebody in the next 80 years, they're going to see the price levels quadruple. And yet a central banker will look them in the face and say, hey, you should be congratulating us. We did our job so well. We kept inflation at 2%. I mean, nobody in their right mind would think of a quadrupling of prices over a 72-year period as representation of stable prices. Are you kidding me? I do think there's issues with really measuring productivity. Adequately. We're using tools that did a great job of measuring productivity maybe 20 and 40 years ago when we were far more manufacturing orientated. So I believe productivity is probably being undercounted. And the other issue is demographics. That is, our population ages, not just here, but around the world. Older people have more in savings, less consumption. And so naturally, that's a headwind for economic growth. But it also explains why price levels may not rise to the levels that the central banks think that they should be at, namely the 2%. And if that is the case, then basically the ECB and the Fed, ECB, first of all, should bring their rates to zero. And the Fed doesn't need to cut rates anymore because there are things going on outside of the influence of monetary policy that could very well explain why inflation hasn't gotten to their arbitrary 2% inflation target. Mm-hmm. None of that's going to happen, of course, Gary.
Yeah.
I mean, they're not going to change their tune. Mm-hmm. But I find that interesting to think about, okay, is productivity actually higher than what we realize, which means we may actually have deflation, but it could be a very good deflation if productivity is stronger than expected. And the demographics, and those numbers don't lie. They are what they are. And, older people consume a lot less than people who are in their 30s and 40s and building a family and getting a house and all the rest of that stuff. So we live in interesting times.
Oh, we certainly do that. Oh, yes, we definitely do that, Jim. So when we're looking at it, and, I was always of the opinion if the economic order is going to come crashing down, the U.S. will be last to the party. Mm-hmm. China is having major banking problems. They've been bailing out banks basically left and right because Chinese banks are in the business of making bad loans. I mean, that is their function. They're more a social
state-owned enterprises.
Right. It's a social policy.
Right.
It's a social policy, and that's not a prescription for a stable economic system because whatever you say about capitalism, it does have a way of rooting out inefficient, unproductive enterprises, sometimes at the expense of productive ones as well. The so-called creative destruction. But what they've got is this creative destruction, not through capitalism, but through state control. I mean, that is actually it's uncreative destruction when you get down to it, because the good ones,
well, again, their theft of intellectual property to enable them to move further along more quickly has been, one of the pillars of their growth strategy. Yeah. And finally, we're saying no mas, and so on that basis, that's the point that I really, as I said, reading Pillsbury's book really enlightened me in terms of what's been going on for a long time and so forth. So you're 100% right. They've got a rigged system, and in the sense of how they lend money, how they subsidize various industries in order to compete on the global stage, and all that's against WTO rules. So China, after joining the WTO, World Trade Organization, made certain promises, and they really have not kept those promises in terms of opening up their markets, cutting back on the support of state-owned enterprises. What they did was pretty interesting. In aggregate, they have shrunk the support for state-owned enterprises. But what they did, which was a very smart decision, is they concentrated their support in key industries like technology, energy, telecommunications. So they, went through the process saying, okay, what is integral for our economy to dominate over the next 20 to 50 years? And those are the industries, and they were right. And that's where they've concentrated your money. But at the end of the day, the companies in those sectors, for the most part, don't earn and don't have a profit margin anywhere near, what private companies do around the world. So they're sowing, in a sense, the seeds of their own destruction. It'll just be interesting to see how long that takes.
And I know you're a student of history, Jim. So when we go back to the U.S. Great Depression, and prior to that, the Roaring '20s, that was supposedly the most profitable time for American business. But when we really look at the numbers, it was a credit boom, and companies were enabled to expand even though the profits really weren't there. They were chasing profits through expansion, but this all blew up. China is really in much the same situation. A lot of these companies that you think are really profitable in China, forget about the fact that you can't believe any accounting that comes out of that country, even though you can't anywhere in the world. At least in the U.S., you know how they're trying to fudge the numbers. But in China, it's like whatever number is on that balance sheet. If we've got $5 billion in the bank, unless you go to that bank and go to the bank's headquarters, not the branch, you don't know if any of those numbers are real. There's a real credibility problem that hasn't been addressed by investors.
Yeah. No, again, unfortunately, you can string that game out for a period of time, but their vulnerability is coming. I mean, debt to GDP now is up to 300% of GDP. So you're right, just like maybe the U.S. in the 20s, they've, and most of their debt is concentrated in the corporate sector. And so, they've been able to borrow an awful lot of money to goose things up over the last 15 years. But at some point in time, they may be able to manage it better than, if you will, a free market environment because of the visibility of real numbers as opposed to invisibility of fake numbers. But ultimately, I think there's a price to be paid. And the working age population in China peaked about 2 or 3 years ago. So they have their own demographic issues that they're going to be facing over the next 10 to 20 years that are going to make it difficult. I saw a chart, and I'll try to find it, Kerry, and I'll send it to you.
Yeah.
It was an interesting chart. It went back to about 1950, and it looked at Japan, Taiwan, South Korea, and their trajectory of growth over decades of time. And what's interesting is it appears that China is hitting the wall of debt and growth much sooner than was reached by these other three countries. And a big part of it, I think, ties back to what you're talking about in terms of utilizing debt to a much greater extent. There are limits even in their kind of system. But I'll try to find that chart and I'll send it to you because it was pretty interesting in terms of comparing China with other countries that, went through kind of the same growth phase where they went from being a developing country into obviously economic powerhouses. And China is running into difficulty sooner than these other countries.
Yeah, not surprising because the escalation of debt around the world, eventually there's a squeezing out, a pushing out of other companies that are more worthy, perhaps, or could do better with the debt, but they can't get it because the governments are taking it in all of these crony enterprises. Anyways, questions, comments for Jim, myself, email is kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Take a look at Jim's site, macrotides.com. Jim, thanks for coming on, and we'll talk to you again real soon.
Sounds good, Kerry. You have a great one.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.